Once again, thank you for joining us today. Hopefully, we're going to go over some topics that are pretty important and relevant to everyone, including myself, right? Because we all have family members and loved ones, who will ultimately pass away, right? There's a couple of things in life that are guaranteed: death and taxes. So although sometimes listening and hearing these topics are difficult, they are necessary, prudent, and will only prepare you better for the future and what's to come, and help you and your family and loved ones, have discussions that are beneficial and fruitful to carrying on your loved ones' desires and wishes and requests. So the title of this is "What Comes Next: Managing and Distributing Trust Assets." Um, Really, like I said in my prior webinar, if you joined that one, I wanted to do like a multi-part mini series, and we're going to do like 2 or 3 of these really, where we did what happens in the beginning of the trust administration, or really probate administration, any kind of administration, some of the key things to consider. This is really going to focus more on the second phase of administration and the third phase. Second phase being managing the estate, doing everything you need to do during kind of the meat and potatoes aspect of the administration, and then getting closer and moving towards final distributions, what is necessary from that standpoint, dealing with taxes, accountings, beneficiaries, things to be proactive about, things to help you quell beneficiary concerns, things to negate lawsuits, and we'll go through a whole gambit of things. But just wanted to give you a brief overview of what we'll be discussing today before we get started with some of the general overview of our firm. That's me, a nice little picture of me. You can already see me most likely, but I'm an estate administration attorney with Cope and Barger. Estate administration is a overarching term. Okay, so an estate administration just means someone has passed away. Okay, now under that could be a probate administration, it could be a trust administration, it could be a miscellaneous administration. It also covers incapacity and conservatorships. So it's kind of the gambit. We just kind of do that. At prior firms, I did a lot. I have a lot of experience in this area, and then I've also done a lot of estate planning and tax planning, as well as trust and probate litigation. So this is a disclaimer page. Everything that I talked about today is not going to be considered legal advice. This is just general guidance. I'm speaking in generalities. If I use specifics, usually I'll use myself and my own family as an example. If you need actual legal advice, please consult with a professional for your particular circumstances and your specific tailored needs. Okay. These are our, I believe this is, we have a couple of new attorneys that have joined us recently, but this generally encapsulates our current attorneys at this firm. You can see that we have, a lot of you are probably familiar with Lloyd and Larry and maybe even Victoria, as well as James in my department, or even Stan. They've been longtime attorneys for this firm, as well as Sonny. But yeah, these are the general attorneys, and some of the areas you see that we cover: estate planning, business and tax, state administration, and estate litigation. We are a full service law firm. It can help you with quite a bit of your needs. Here's just a general picture of our staff. It has attorneys, but it also has the other people that make this firm actually run, right? The paralegals, the legal assistants, marketing, billing, accounting, you name it. This is kind of a nice firm-wide picture of our firm. As you can see, I did not get the memo and wore a light gray. I wish I knew everyone was going to be wearing a black or dark blue, so I didn't stand out as much. These are some of our offices. A lot of you have met with us at numerous locations. I am currently located in the South Coast Metro main office. That's here in sunny Southern California. Okay, today's agenda. So these are 4 of the main topics we'll be covering. The trustee role. So I did dive into the trustee role a lot more in my prior webinar. I'm going to briefly discuss that again, and I will probably weave in and out some of those prior concepts into this one. For those that did not attend to the last one, you'll kind of get the gist of what what that really means, what that requires, what is a trustee, what do they do, what are their responsibilities, what are their liabilities, what are fiduciary duties, and how does that play with managing the trust assets? How does that play with distributing the estate? Okay. Next, managing trust assets. Like I said, that's really phase two of an administration, right? You've gained control to all of the assets. You've sent out all of the initial notices to the beneficiaries and heirs. You've sent notices to the government entities and any other applicable third parties, creditors, you name it, that need to be advised of the administration. Okay, now you're moving into the I'm managing the assets, I'm paying expenses, I'm valuing the estate, I'm dealing with purchases and sales, I'm dealing with beneficiaries questions, I'm dealing with these other third parties questions, and I'm dealing with creditors. Okay, so really the probably the most primary focus of the administration and the longest period of the administration is managing that, like I said, phase two, managing the trust assets. Okay, and then we will also be discussing distributing the estate. What does that look like? What is the process? What are some things to be aware of? What can you do to be more proactive in regards to distributing the estate? Things to be aware of, things that you may not be able to negate. And I'll go through some examples of where the trustee has done everything appropriate, but the beneficiaries are still not complying. How do you get around that? What are some strategies, and how can you have discussions and communication with beneficiaries to attempt to navigate some more complex and more difficult situations? And then lastly, protect and comply. I think that goes with everything that you're doing as a trustee or any fiduciary, whether you're a financial advisor, a CPA, an attorney, a trustee, an executor, right? Any of those roles, you're acting on behalf of another person, another entity, or others, in plural or in the aggregate. And everything that you do is going to be scrutinized. So it is very important to follow the rules, the instructions, the law, and follow the guidance of your own advisors, and that will provide the most protection. Okay. And again, I'm going to flesh all this out. This is just a kind of general overview of our agenda today. The trustee role, understanding the role. So I'm going to again briefly go through what the trustee role is and how that's going to implicate the rest of the discussion. So kind of the main bullet points here for a trustee is understanding your role, right? Acting in the best interest of the beneficiaries. When you become trustee, a lot of people, will get upset because their parents named their sibling as trustee, and they go, well, now this person has all the power and all the control. And yes, that usually is the case. However, they have all the responsibility, they have all the liability, and they have numerous fiduciary duties that attach to that role. So there are actually statutes under the California Probate Code which specify all of these various fiduciary duties that attach to this trusteeship. Okay. And one of those, and it's a very key and important one, is acting with a duty of trust and a duty of care for the trust and its beneficiaries, and acting in the best interest of those beneficiaries. And different beneficiaries can have different needs. So you have to be constantly aware of the evolving and changing needs of the different beneficiaries. They're all different class, different characterization of beneficiaries, right? You could have one person over here who's getting a specific gift. They're getting a $10,000 gift. And then you have someone over here who's getting 1/3 of the remainder of the estate, right? Those are two different beneficiaries. One is a specific gift beneficiary, one is a residuary beneficiary. They both are entitled to potentially different things, and they have different requirements under the law. So you have to be aware of those interests, right? The trustee's attorney and financial advisor can help guide you through that. But again, the main aspect is here is act in the best interest of the beneficiaries. Now, I will say as an aside, sometimes acting in their best interest does not coincide with that actual beneficiary's reality, right? They may want something that you are not going to do or want to do because it's not in their best interest, and that can create friction. So later on, we'll kind of go through some more examples of that, and I'll flesh that out. Just want you to be aware that sometimes doing what they want isn't always necessarily what's in their best interest. Next is staying compliant with California and fiduciary laws. Kind of already glossed over that as well. Right, you're going to want to comply with any of the terms in the trust. So if there's any fiduciary duties or any responsibilities or instructions in the trust, you're going to want to follow those as long as they're not illegal or against public policy. And you're going to stay compliant with all the California fiduciary duties, right? So all of the fiduciary statutes that say here's duty 1, duty 2, duty 3, duty 4, you're going to want to be in compliance with all of those. Sometimes not all of them apply. There's like 3 dozen fiduciary duties. Sometimes it could be that your estate really only implicates 4, 5, 6, right? Whereas others may implicate all of them. And a common theme I come across over the years of handling these types of matters is that I'll meet with a loved one who's administering their family member's estate, and they'll go, "Look, my estate's very simple. There's not going to be any issues. I'm not going to have to deal with this." And people seem to think that because their loved one or family member or friend had a modest estate and wasn't a multi-millionaire, that for some reason it's going to be simple. And that's absolutely just not the case. In fact, more often than not, it's these smaller estates that have more issues. So it does not discriminate based on asset value, nor does it discriminate based on asset type. I have clients who come in and say, my loved one had a trust and 3 bank accounts. This is going to be very easy. And I have to try to explain to them that it's not the value of the asset and it's not the type of assets or the minimal amount of accounts that makes a administration difficult. It is the trust itself, the distribution provisions, the legal obligations, the notices, creditors dealing with beneficiaries. I mean, it can get very, very complex and difficult and complicated over an estate that had one piece of real estate. Okay, so there's a lot that goes into it, just to be aware of that and to make sure you're staying compliant. And then managing assets responsibly and transparently. Okay, so responsibly, right? That should be in quotes because that's going to be different in every single case, right? What does responsibility even mean? I can't give you a definition because, like I said, it's going to be case by case. But really, most of the time when you're dealing with a trust administration, you have to do things fairly, equitably, and responsibly, and most importantly, being transparent. So, as one of those fiduciary duties, a trustee has to keep the beneficiaries informed. Now, again, there's no definition to what that actually looks like. That actually looks like, and what that really means is, that could mean weekly updates. Depending on the circumstances of the administration, it could mean monthly updates. It could mean quarterly updates. It depends on the actual administration and what is going on and what's happening. A lot of times, though, generally I tell trustees, hey, give the beneficiaries updates every 3 to 4, 3 to 5, 3 to 6 weeks. And a lot of times what happens is, the trustee will be doing their job phenomenally. They will be doing everything they're supposed to be doing. They'll be accomplishing everything, but they didn't tell the beneficiary or the beneficiaries anything for 6 to 9 months. And the beneficiaries have no idea that the trustee is doing their job. They just think that the trustee is either not doing their job or they're doing something nefarious. Okay. And, while I try to preach and tell people to not automatically default to the negative, it's just human behavior to do that. And you can really negate a lot of those types of issues with just frequent communication. Okay, and sometimes the communication be as simple as a one-line email. Sometimes it's a little bit more in depth. Sometimes you're seeking beneficiary input for particular purchases and sales, and maybe even for distributions. So like I said, it's going to be case by case, but as long as you're doing that, you're protecting yourself. And if you're protecting yourself as trustee, you are protecting the trust. Whether the beneficiaries see that or not is a different conversation, but you are doing your job correctly. Okay, so trustee role beyond the initial phase, right? So the initial phase is like kind of, dealing with the funeral and communicating with the family, setting a meeting with the CPA, setting a meeting with the attorney to try to go over the initial documents, right? That has all occurred. You've hired the attorney, your CPA has been made aware. You are now actively trying to gain access to the assets, excuse me, gain access to the assets and start managing the estate as a prudent fiduciary would. So first is transitioning from setup to active management, right? Setup would be, okay, I'm going to open up the new trust checking account with, my name on as trustee of this ABC trust. And I'm consolidating the assets into this account to the extent that I can. And then I'm managing that account. I'm paying the expenses. I'm also finding out what expenses there are, right? There may be auto deposit expenses that I need to be canceling or shifting over, right? If there's a house that's going to remain current for a while, or indefinitely, right? I'm going to be shifting over those auto deposit utility expenses to make sure they're coming out of the appropriate account, or I'm canceling ones that no longer are necessary. Like I said, case by case, but you're doing all of this work. Same thing with any, you're dealing with credit cards and mortgages. And if there's businesses, you're dealing with business partners, business expenses, business accounts, you name it, right? This is all now the active management of the estate. Of course, you should be relying on your attorney for advice. If there's a rental property, you're including the property management company, or if there are none, you're finding the appropriate professionals to help you with this. Okay. Um, Common challenges in asset administration, and then why attention to detail matters at this stage. So again, I'm going to defer on the common challenges in asset administration as I kind of go through this. They'll kind of be fleshed out on each side, and then why attention to detail matters at this stage. So I will say attention to detail matters at every stage. So I mean, yes, it matters at this stage a little bit more. I would say in this type of administration, or any type of administration, detail is always going to matter. Why? Everyone is scrutinizing your every move. Every beneficiary is scrutinizing you. The taxing authorities are scrutinizing you. The state of California may be scrutinizing you. The court may be scrutinizing you. Other family members may be scrutinizing you, right? You have everyone that's looking at you. So making sure you're paying attention to the details, and seeking assistance when necessary, right? If you're concerned, if you have a thought, and in your thought you say, I don't know if this is appropriate, or I don't know if this is correct, that should be an immediate red flag that you need to seek advice and consult with somebody, okay? Be conservative. Always be conservative in this instance. Seek advice before you take the action. I can't tell you how many times people take the action, then have that thought, then seek the advice. Now, it doesn't mean, you're SOL. It just means that, potentially there's going to have to be some remedial or corrective work, and that usually results in higher costs and fees. So we want to avoid that, from a liability standpoint on your end, and then also just from a saving the trust and potentially your own personal financial pockets from additional unnecessary expense. Okay, managing trust assets. What needs to be done? So, like I said, in my prior webinar, we really discussed the beginning stages of the first 30, 60, 90 days of an administration. This webinar is really going to focus on, okay, those first 60 to 90 days have passed. Now you're really focusing on managing the trust assets, the trust affairs, and the necessary action items during this process. What I will say is the most important aspect during this phase is the inventory. Okay. And really what this is, and whether you're working with our firm and another firm who specializes in this area, right? This is normally called what we call, in our industry, as a date of death inventory. It is a snapshot of all of the trust assets as of the date of death. And if any of you have worked with me or James in my department in the past, you know that when you first met with us, we sent you a letter. And that letter said, hey, bring a list of all this information. Now, sometimes you don't have it, which is perfectly fine. But it says we want date of death values for checking accounts, savings accounts, CDs, investment accounts, brokerage accounts, annuities, life insurance, 401k, IRAs, real estate, mortgages, right? We're asking for all of it because that's what's going to be going on this inventory. Okay, it's a snapshot of all the trust-owned property as of the date of death. Okay, so as part of this, right, some of you and some of your family and some of your loved ones, right, you may have more or less information than others. So sometimes in this process, I have clients that come to me and say, hey, my father had a spreadsheet that I had access to and we worked on, weekly for the past 20 years. I know all of this information. Here it is. That's great, right? We really don't have to spend much time identifying the trust property. However, there's numerous times where, people come in and say, hey, my sister or brother or father or grandparent or cousin did not tell me anything about their assets. All they said was that I'm the named successor trustee. Here's Cope and Barker's contact information, and this is all you know, right? So as a part of this process in managing the estate, you're identifying all the trust-owned property, right? Whether that's real estate, whether it's cash accounts, whether it's investments, whether it's collectibles, artwork, you name it, you're trying to identify, and you're working with our office to put together this inventory. Okay. Along with that, it says locate deeds, titles, financial statements. I'll kind of give you a little tidbit here. A lot of times people come in and say, hey, I don't even know where to begin. I don't know where to even find this information. Okay. A good place is always their past tax returns, right? Because a past tax return will always report any sources of income, even if they didn't pay, let's say they didn't actually owe any taxes for 2024 or 2023, whatever the case is, right? But they still filed, right? It's a good place you'll see the sources of income. So if there was interest being reported from cash accounts, or dividends and interest from investment accounts, or RMDs from retirement accounts, or an annuity payment from an annuity, or whatever the case is, you'll see that income. That's a good place to go. It's also good to contact a financial advisor if you know who they are, or what firm they are at. Same thing with the CPA. That's all a great place to look. Another good place is the mail, right? Having access to mail. Why? End of the year, financial companies are sending 1099s. Okay. And if they were employed in that year, you may get, information regarding W-2 wages. And so that's also another place to start looking. And now you're starting to put a complete picture together. This process may take a very long time. Like I said, I have people who come in with 100% of the assets, and the inventory phase takes less than a month, right? I have times when people have no idea what the assets are, and the inventory phase takes more than a year. Okay, so just be prepared that there is no set timeline, and this inventory period can take quite a long time. Sometimes you know where the assets are, but you have to get date of death values, right? So you're contacting as an sorry, you're not administration, you're contacting the financial institutions, and you're having to deal with the bureaucratic process, right? Their internal procedures of when and how they give this type of information. And that can take some time, right? You may up sitting on the phone for hours on multiple days trying to get to the appropriate person. Then when you finally get to the appropriate person, then you're going to have to go through their internal checklist of what you need to give them so that they can make sure and confirm that you're the appropriate person that they can lawfully give this information to. Some institutions are better. Some account managers are better. Some managing supervisors are better, right? It's really hit or miss. That's something that out of your control. That's something out of our control. But if you have a beneficiary that's causing issues, you can alleviate some of that and by setting boundaries and expectations and saying, hey, I contacted them. This is a process. It's going to take time. They want their money and they wanted it yesterday. Unfortunately, you just don't have the ability from a time perspective to be able to do these things too quickly. And a lot of times I've seen in the past where clients come in, they go, okay, I've distributed the assets, they want them quickly, it's done. And I'm sitting there saying, well, yes, you appeased the beneficiaries, but here's all the problems that you just caused, of which the beneficiaries are not going to be happy of when they find out. Okay. So just again, communicating, being transparent, being upfront, and just setting boundaries and expectations that this is going to take time. Okay. Again, with assistance, we'll walk you through that and help you make sure you're doing it appropriately, but it's a time consuming process. Continuing along with that date of death inventory, right? Once you locate all the trust assets, we're getting values, right? You're pulling the date of death a statement for cash accounts. You're reaching out to the investment or brokerage institution or whatever financial institution has various retirement or non-retirement investment accounts, and you're getting valuation reports or the date of death or quarterly statements. For real estate, you're obtaining formal appraisals for real estate, business, and some high value personal property. So to kind of go off on this first bullet point here, obtain professionals to appraise the appropriate assets. A lot of times I have clients that say, hey, can I just use a Zillow estimate? The answer is no. Can I use a realtor opinion letter? My agent told me I can use that. No. Can I use a broker opinion letter? My broker told me I can use that. No. I don't know why real estate agents and brokers have continued to say this. Broker opinion letters and realtor opinion letters have not been accepted by the state of California or the IRS in decades. So I don't know why they're continuing to do that. And I also don't know why they're providing legal advice. So remember, if a bank person says something, it gives you legal advice. If a financial institution gives you legal advice, if the realtor or broker gives you legal advice, please respectfully decline and say you need to consult with the appropriate person, right? Consult with the CPA if it's tax advice. Consult with the financial advisor if it's financial advice. Consult with the attorney if it's legal advice, okay? And we try to work together with all these professionals. I'm not wanting to come across in a hostile or contentious nature. Just I need to protect you, right? Our goal is to protect you, and you need formal appraisals done, right? Now, that's not to say that the formal appraiser of a real estate, isn't going to look similar to an opinion letter. right? Or it's going to be a comparison of the sales that occurred at that time, and that's going to be listed on there. So yes, there's some crossover and some information is going to be the same, but having it done by a licensed appraiser, the appropriate licensed appraiser is paramount. Okay. And I'll take one step even further. I had a case where the client his family member had an LLC. That LLC was managing about 4 or 5 pieces of real estate, as well as an operating account and an investment account in there. And they hired a certified appraiser to appraise that. Now, they hired somebody who specifically specialized in residential single family real estate, right? And this person, I don't know why they performed this, but they obtained appraisals, and everything in there was multifamily. Like I said, more than 10 units in each one of those pieces of real property, of which this appraiser had no experience. So even though they hired a professional, it was the inappropriate professional. Okay, so you want to be confirming with us and making sure that you're hiring the accurate professionals to do the appropriate appraisals. For valuables, right? A lot of times, if you've met with myself or any other trust administration attorney, we try to just aggregate personal property, right? Your stuff. Okay. So we're telling people, hey, yes, we realize that this person had forks and spoons and knives and furniture and clothing and appliances, and they, and normally we say it's not necessary to line item and get a value for all of these. We usually just aggregate the value as long as it's appropriate. And then if an estate sale occurs, we may even use the estate sale value, because that's actually what was exchanged at an arm's length transaction between a willing buyer and a willing seller. So that's usually more like a true, accurate depiction of fair market value. Now, when I say get an appraisal of valuables, that's for substantial values, right? We're talking high value jewelry, high value art, collections, collectibles, antiques, things that, and again, not maybe, I don't like necessarily to talk about the purchase price, because you could have purchased something for $10,000 or $20,000 and it's no longer worth that. So I'm talking things that have a, basically sale value at that point that's going to be valuable. And then if in doubt, get it appraised, right? If in doubt, get it appraised. If a beneficiary complains, unfortunately, that is too bad. You have every right as the trustee to value the assets. Okay. Now, valuing spoons and knives and old clothes and furniture that's been in the house for 40 years, not prudent. Okay. Not only is that not prudent, it's not necessary, and it's just an expense that's not going to protect you. Okay. Confirm fair market value for accurate reporting. I think I kind of addressed that as a part of all of the valuations that we're going to be doing, and then keep all valuation documentation organized for records. So we're going to be putting together that date of debt inventory, which is going to show a list of the trust assets, how title is held, the date of death value, and then any specialized notes that may need to go with that asset. Okay, whether it's hey, this was we only appraised 50% of this real estate because the trust only owned 50%. Or it was the trust only owned 20% of this LLC and we got a fractional discount appraisal. So we're putting that in there and rectifying that it's not a complete 100% value. Whatever the case is, we're denoting on this inventory. This inventory is extremely important because, one, should you have to prepare a formal accounting in the future, you're going to need all of these date of death values, because that's the beginning of the accounting period. One, two, in most instances, this trust data inventory is also going to function as a cost basis schedule, right? A lot of times you'll hear the CPA or the attorney say, hey, there are potential step up in income tax basis for the beneficiaries who are receiving this property, which is a huge, huge benefit to them. So this can also function in certain instances as a basis schedule, which is great should you ever sell any of the property, or should you distribute the assets and the beneficiaries later sell the assets. Okay, so you want to keep all the documentation that supports this inventory. This inventory is great, but right, you and I could really put any number on there. We need to have the backup support. Also, and I'm going to talk about this accounting later too. If you're required to prepare a formal accounting, and you send it out to the beneficiaries or you file it with the court, people may ask for the backup support. Okay, and you want to have all of that information neatly organized, because it'll just save you time, stress, and a headache in the future should someone ask for that information. Managing trust assets continued, duties, and deadlines. Okay, so as a part of this, right, we're going to have to, and if you've met with myself, right, we talk about a whole host of different taxes that are implicated, okay? And some of those are, and if you've been to any of our seminars and you've stayed after the estate planning attorneys and business owners have spoken, if you listen to James or myself speak, we usually put a slide up that goes through, 6, 7, 8 different taxes that you need to be aware of. That doesn't mean all of them are going to apply for your particular instance. We just have to give you a wide sweeping gambit of everything that could be implicated. At the end of our discussions and during the administrations, we flesh out what is actually necessary. So one, filing necessary tax returns on time. Okay. Now, sometimes you're not able to do that. Sometimes someone passes away in November, right? And now, you've met with us in January and you're dealing with the family and grief and the funeral, and you meet with us and then you retain us, and April's there, right? If they pass away in November of 2025, they have to file a personal final income tax return that would cover January through November of 2025. That is due April 2026, like our standard returns are. And based on that timeline, you're in a crunch, right? Even if you're doing everything timely and appropriately, you may not have all the income. You may not have all the 1099s. You may not have all the W-2 information. You may not have all the other deductions that you're going to be claiming on behalf of them. You may not have met with the CPA yet, right? You may not know where all the assets are. Maybe your loved one didn't even file prior income tax returns. So you have even less information to go off of. So filing these returns on time also means just being aware if you can't file them timely, right? We can always file for extensions with the IRS in the state of California, as well as any other state if they're implicated for income tax reasons or estate tax purposes. And we're filing the necessary extensions to give you the appropriate amount of time so that you can gather this information and timely file. There are also strategies and things that we can do from a tax perspective for other tax returns, like trust and probate estate income tax returns, gift and estate, federal estate tax returns. There are strategies. If you meet with us and you meet with the CPA timely, doesn't mean you have to do something immediately. It just means that we have more options. And if we have more options, usually means more flexibility for the trust and the trust beneficiaries. And usually that means we actually may have the ability to implement some tax saving strategies, which will ultimately help the trust and the beneficiaries, right? Which just means you're fulfilling your duties even at a higher level, okay? Understanding the different taxes, right? A big one is understanding income versus estate tax. And really what gets complicated in all of this is these terms. You'll see the term estate, you'll see the term trust, you'll see the term probate, you'll see the term income, right? And a lot of these have different meanings in different contexts, okay? So a lot of times when you hear estate tax, it's not the trust income tax, it's not an income tax, it's an estate tax, okay? That is a tax to the heirs on basically the size of the estate. If the size of someone's estate is larger than their exemption, then they're going to have to pay estate tax. And when I say they, I'm talking about the beneficiaries. Okay, so I've passed away. My estate is $100 million. The current exemption, I'm going to use next year's because it's 15 million. It's a nice round number. It's 15 million per person. Okay. Now, if I have a $100 million estate and a $15 million exemption, that's $85 million exposed for estate tax, right? And my heirs are going to have to deal with that. And there are strict deadlines. Okay. Now, in my example, maybe I certainly don't have 100 million, and I'm sure most of you don't either. I just wanted to do kind of a grandiose example, dramatic, to show that's that estate tax. Okay. That doesn't have to do with the trust or probate. That's all of someone's assets, regardless of how they're titled. That's what that estate tax is, right? Versus income. Okay. Now, if I'm dealing with income that was accrued, right, and this is most cases, income accrued prior to my passing away, right? From January 1st of 2025 through my date of death, November 1st, 2025, I was working as an attorney, right? And I was receiving W-2 income from Cope and Barter. Okay, so I pass away, and my loved one needs to file my final individual income tax return, right? That's our standard if you live in California, right? Our 540, 1040, and they're reporting my employment income on that, okay? But that's my final individual return. Once I pass away, if I have a trust or if I don't have a trust and my loved ones have to probate, right? Hopefully, I'm going to disregard probate for the purposes of this, but it's a similar concept. If I have a trust, right? From the date of death and onward, so from November 2nd of 2025 and onward, my trust is going to be earning income, right? Because if you go back to the first slide, the trustee is opening up a new trust account and opening up new brokerage accounts in their name as trustee, but they're not using their family member or loved ones. They're not using my social security number anymore. They're getting an EIN for the trust itself, right? And an EIN is a social security number for the trust. The trust is now a tax-paying entity. So from November 2nd until final distributions have occurred, the trust may be generating income. And now you're filing timely tax returns for the trust. Okay. And if you're in California, you're California trustee, California administration, right? That's now a 541, 1041. Okay. Not to be confused with our personal 540, 1040. And you most likely will have to file both of those. So you have to rectify that you're going to be filing a final individual return and trust income tax returns moving forward. Okay. Now there are different timelines and there are different strategies and different benefits that can be involved and implicated in both of those. And that the CPA, the trust administration attorney, will make you aware of those. Okay. Same thing with the estate tax, right? If you're still going to want to talk about that no matter what. And if you're a surviving spouse, there are certain benefits for estate tax, even if you don't have to pay it. So you're going to want to be discussing these things in a timely manner, even if they don't ultimately affect you or the beneficiaries. Okay. And then lastly, coordinate with accountants or tax advisors for accuracy. Absolutely. I would say no matter what, coordinate with your accountant, coordinate with your CPA for accuracy and making sure that these tax returns are done appropriately. In most instances, and I have people that say, I have family members that come in and say, hey, look, I have been filing my mom's 540, 1040 for the past 10 years. Okay. Do I need to get a CPA in that instance? And normally, I'll say, look, you should always consult with a CPA. However, that's your personal discretion. If you've been doing this for so long and you feel comfortable doing this and none of the income has changed, right? It's not like a whole windfall came in that year and it changed the makeup of their estate, making it much more complicated. If everything's status quo, then yes, right? You can file that personal. Then they will say, well, can I do that trust income tax return? And I'll almost always say, normally that's a much different return. And I would say almost always default to the CPA or accountant or enrolled agent to do that for you. But generally, you're going to want to be having the CPA assist you with this, if not just doing it themselves. By having the professional do it, you really absolve yourself of liability, right? If you're taking it on yourself, you are exposing yourself, and the beneficiaries have more ability to challenge, right? Because you're not leaning on the professionals. Now, again, doesn't mean you've done something illegal by handling the tax return yourself. There are certain instances where it's just easier and prudent, like in the example I gave where I did my mom's tax returns for the past 10 years, no additional or unusual or peculiar income has come in 2025. She passed away in November, right? It's not a big deal. Okay. Avoiding pitfalls. So maintain detailed records of trust income and expenses. So some people take this to the extreme and some people don't do this at all. At a minimum, you should be printing or compiling monthly statements for all of the trust accounts from the date that you open those accounts up or gain access to those accounts. Okay. If you're more computer literate, like don't want to have physical files, right, you're creating a file on your computer that says Bank of America account, Charles Schwab account, Fidelity 401k account, right? Whatever it is, and you're pulling in those monthly statements and you're just organizing it to make sure that you're detailing this, okay? Then you have an expense folder, right? Now let's say you're using Bank of America as your trust checking account and you're paying all trust and estate related expenses out of that account, which is great. You've consolidated into one account. You're paying expenses out of one account, but you're going to want a folder to have an expenses folder to show all the documenting support that you have, right? The receipts, the electronic receipts, the physical receipts, invoices, right? You've paid attorney's fees. You got an invoice for that. You're going to put it in there. You paid a CPA to do the tax return. You put it in there. You did an appraisal on the residence and on your parents' vacation home. All right, or on your loved one's investment property, you're putting the invoices in there. You're itemizing all of the expenses, right? You're keeping detailed and accurate records. Should anyone challenge anything that you've done or an expense, or that you did something inappropriately, you have all this backup support and it's neatly organized. And that just means you're easier to defend yourself. And again, I'm going to harp on this. If you defend yourself and you're doing the right thing, you're defending the trust. If you're defending the trust, you're defending the beneficiaries. Okay. They may not be happy. They may still file a lawsuit against you, but you're doing what's appropriate. Okay. Now we can't stop anyone from filing a lawsuit, but what we can do is easily defended if you've done it appropriately. Okay. Tracking capital gains or losses from asset sales. So I'm going to go back to that inventory, right? We're getting the date of death values for everything. And as trustee, normally, right, under California law and the probate code for statutes that deal with trust, and usually under most trusts in the trustee powers, right, the trustee will generally, again, generally speaking, have the power to sell assets, right? So if you sell your parents' primary residence, you're going to want to make sure you're tracking capital gains or losses, right? And a brief overview of what capital gains or losses are. It's the tax that the state of California, which we have, state of California has its own capital gains tax, and the IRS, the federal government, has a capital gains tax rate on profit, right? If you buy Apple stock for $1, and if I buy, I'll use myself, I buy it for $1 and I sell it for 100. Okay, that's great. I made $99 on that stock. That's fantastic. That is a huge upside. State of California and IRS also say that's fantastic. We want to tax you for the profit, the capital gains tax. Okay. But there are huge benefits depending on the design of the trust for step up and tax based purpose, right? So let's go back to that example. I bought again, generally speaking, there are differences depending on the type of asset and ownership. So again, you're going to consult with the attorney, consult with the CPA. This is all general speaking and not actual tax advice. I buy it for $1. I put it in my trust. I pass away. The family comes to Copenbarger and meets with an attorney. They do the date of death inventory, which shows that I bought it for $1, but on the inventory it's worth 100. That could be, in most instances, now the beneficiary's basis, right? So if they sell that stock for 100 and their basis is 100, on paper they've made $0, right? In reality, they've made 99, but on paper they've made zero, and they're reporting no gain. So it's very important to track those because you're going to have to file tax returns for the trust. And if you're selling things and there are capital gains or losses, you need that for the CPA. You need that for the tax returns. Because if you sold a brokerage account and it ended up with $100,000 in losses, but you sold the residence that ended up with $100,000 in gains, right? You're going to want to be tracking this and giving this information to the CPA because in that example, the gains and the losses negated each other, right? So it came out as a wash, zero tax paid in that particular instance. And again, I'm not including deductions and depreciation and exemptions and credits, right? That gets outside of the scope of this conversation. Okay. But tracking all of this, making sure you're aware of it. Okay. And then not only that, a lot of times people will rush the sale of a real estate. There are certain forms in California that talk about withholding and it talks about what the basis is, and they will fill those out quickly and uninformingly and at the bequest of the real estate agent or title or escrow, and they'll put the wrong information. And all of a sudden, the state of California is withholding when you didn't need to be subject to withholding. Why give the state of California funds to withhold when you didn't have to in the first place? Okay. And I'm going to take a standpoint of always properly report things to the IRS, the state of California, but don't withhold when you don't need to withhold. Why get the money when you don't need to, right? You can keep that control and then file the tax returns and pay tax liability when it's the appropriate time. Okay, and then ensure compliance with both state and federal laws, right? If you're in California, make sure you're working with a CPA that is understanding of California and federal. I do work with trustees who are located outside of California, right? It could be a California trust with California assets, with a California decedent and California beneficiaries, but the trustee lives in Idaho. Okay. And they've hired our firm or another firm to handle the trust administration based on California law. And they hire a CPA in Idaho who can handle the 1041 because they understand the federal, like most CPAs in most states, but they have no experience with the California returns. Right, so you want to make sure you're staying in compliance with this not only state but federal law. And by the way, I do see that there are some questions that come up. If I can finish this timely and quickly, I'll address those questions during the webinar. If we don't, please submit them. My marketing team, who's also on part of this webinar, will be taking those down and sending them to me afterwards, and I'll try to get to them, to the questions that I am able to answer. And if I'm not able to answer it, I'll tell them, say, hey, this person needs to meet with an attorney or whoever to get a fleshed out, more individualized answer. So moving on, distributing the estate. Okay, now we've finished that first phase. Now we're moving towards the distribution phase and trying to wrap up the administration. Okay. Distributing the state strategies for asset management, deciding, and these are all just aspects that really implicate almost every single administration, regardless of the size. Okay, deciding whether to sell, retain, or lease real estate. Sometimes the trust will tell you what you were supposed to do. Okay, sometimes the trust is vague. Sometimes it doesn't really matter because you're the sole beneficiary and the trustee, so you don't need to really have a too in-depth of a discussion because you're the sole person who's going to be benefiting from the estate. Um, and that's not really necessary or prudent, or maybe this parent or person left a specific real estate property to a specific person. And so you have to be looking at all of these different factors, and the attorney will help guide you through that. Um, and then also discussing whether to sell, retain, or lease. What are the implications? Okay, if we're leasing this um, um, the primary residence to third parties, right? What tax implications are there? Are the property taxes going to go up? We need to be aware of that. We have to build that in potentially to the rental price. And then also getting the appropriate professionals to help with liability, creating LLCs, or potentially dealing with property management companies and so on. Okay. If you're selling it, what are the pros and cons from a management perspective, from a tax perspective, from a liability perspective? Okay. Same thing with managing investment portfolios prudently. I will always tell every trustee, unless you have 20 years of investment experience and you have your Series 6, Series 7, 67, 66, all those professional licenses, and you are basically a financial advisor, you're a CFP and or whatever the case may be, right? You shouldn't be managing these investment portfolios, right? You're exposing yourself incredibly to liability by doing that. You should have appropriate advisors guiding you on those portfolio investments. Okay. Not only that, there's something called the prudent investor rule in California, and it has like a whole host of factors that you have to take into consideration when you are investing assets. And one of those key factors is, okay, what's the benefits of the trust and the beneficiaries, and what does each beneficiary need? So that you have to be communicating with beneficiaries regarding and getting their thoughts. That doesn't mean you have to ultimately take what they're saying and enact it. You are the trustee. You're the one who has been provided with the power and the authority to make the decisions, but you should seek guidance and input when appropriate. Okay. And then addressing ongoing business interests responsibly, right? So if your loved one was an independent contractor and had their own business, or they had a sole proprietorship, or they had a business with multiple partners, right? You're actively communicating with the other business partners. You're giving them the appropriate information. You're getting the appropriate information so that you can address buyouts, insurance, day-to-day activity management, employer issues, HR issues, you name it, right? You want to be doing these things timely. You're talking to the administration attorney, and then you're talking with the business itself and potentially attorneys for the business to ensure the next steps are done appropriately. Okay. And again, also addressing taxes and ongoing responsibilities, liabilities, shifting of ownership interest, shifting of managerial control, valuations, obtaining the appropriate business documents for the estate administration attorneys and the CPAs and so on. Okay. Um, real estate. Okay. Kind of already talked about this, as fleshes a little bit more into real estate in particular, securing and maintaining the properties. Okay. And securing the properties means removing squatters, right? Filing eviction proceedings for people who are not paying rent, right? And if someone wasn't paying rent prior, and there are things you need to discuss with the administration attorney on whether you should be charging rent now, whether it's okay not to, right? And it's really going to be case by case on whether how to arrange that, what the pros and cons, what you need to do to protect yourself, securing the property by removing unlawful individuals, whether that's squatting or tenants who aren't paying. It's changing the locks, right? It's trying to protect it so that it doesn't get destroyed, getting it ready for sale, keeping utilities up to date if there's going to be showings to potential buyers and a potential sale, or if you're going to have a tenant, making sure you're keeping up to date with the property management company and keeping the property current, so that they don't have any claims against the landlord, the trust, right? So that they can withhold funds from rental income on a monthly basis, or whatever the original contract or the new contract is going to say. Obtaining updated valuations and inspections. So getting the date of death appraisal. If a year down the line you're going to be selling the home, right? The buyer will probably get an appraisal. If there's financing involved, the banker's probably get an appraisal. You may want to get an appraisal. If the trust gives a right of first refusal to a list of people, right? You may be using the date of death value, you may be using a more current value. What does the trust say? Or if it's silent, what have the parties agreed upon? So on, so case, right? You're getting the appropriate valuations at the appropriate time and getting the appropriate inspections also at the appropriate time. And the coordinating sales or transfers according to the trust terms. So this is very important. As long as the trust is not saying something illegal or against public policy, your job as trustees to follow the instructions. Whether the beneficiaries like that or not is irrelevant for these particular purposes, right? Your job is to follow those instructions to the extent that is lawful and appropriate. And if it's not, you're consulting with the attorney to make sure that you're doing what is appropriate or seeking appropriate approval when you need to, right? Whether that's beneficiary approval, whether it's court approval, whether it's creditor approval, so on and so case, just depending on the circumstances on your particular matter. Okay. And for example, if I have been given a right of first refusal to purchase my parents' primary residence over my brother, right, that means I have the ability to purchase the property from the trust. And if he's the trustee, he needs to be giving me that ability timely. I need to be timely executing that right of first refusal, and then we need to be working together to effectuate that so I can purchase it from the trust. Okay. Or conversely, my parents left me the property as a specific gift and then said, to my brother, you get this other property as a specific gift, and anything else that remains go to our 4 grandchildren, right? And in that case, if I'm the trustee, when I'm getting ready to distribute, I'm making sure I'm distributing the proper property to myself, and anything else I need to be doing from filing with the county recorder, the assessor, tax implications, and I'm doing the same for my brother as far as that property that he's getting. Okay. Well, again, pursuant to the terms of the trust. Timing and methods of distributions. Okay. You have to determine when distributions can safely be made. Beneficiaries don't like this, right? Again, they want their money yesterday. But as you know, all those initial notices that we talked about in my prior webinar, gaining assets, gaining control, all of the initial steps, and then actively managing and dealing with the estate and valuations and tax returns and creditors and expenses and consolidating and valuing takes time. And then not only that, right? Even if we're in the distribution phase, there are parts of that distribution process that need to occur, right? We need to be sending out usually waivers of accounting to everybody. We're trying to have everyone sign waivers of accounting. And if they're not going to sign those, we're sending out final receipts. We're doing a distribution schedule. We're trying to figure out what's going where, how much is going where, how it's going to who and when and where and how, right? Are they receiving in kind? Does this person want the 100 shares of Apple? Does this person want the liquid cash proceeds from the sale of the sale of their portion of the Apple stock? Okay, whatever the case is, we're dealing with all of that. We're notating, we're documenting, we're holding back appropriate money in a reserve so that you have funds to pay for the final tax returns, which may come after you've made distributions. If you make distributions and you don't have anything back for taxes, where are you going to get the funds to do that? And what happens if the IRS audits you and says, hey, you paid 5,000, but based on our review, you owe 20, right? You have to then try to go claw back those funds from the beneficiaries. Good luck, right? Good luck trying to get those funds back, especially if this is a year, 2, 3 years down the line and they've spent it or invested it or it's not liquid anymore. That's just not going to happen. So you're taking into account future expenses, holding back an appropriate reserve to provide for such. Also, right, if beneficiaries are not willing to comply, what if the beneficiaries don't want to sign the receipts? What if the beneficiaries don't want to sign waivers of accounting? What if the beneficiaries are requesting information outside of those things, right? How to deal with that, okay? And you're working with us to navigate that. Again, those aren't necessarily bad things or negative things. They're things that are appropriate and under California law, and we want the beneficiaries to be able to have these rights to make sure that someone's not mismanaging the estate. But again, you're talking with us to make sure that distributions are made at an appropriate time when they can be safely made to not jeopardize you or expose you to liability for making improper distributions, or to not expose you to not having enough funds to deal with the ongoing or future anticipated expenses. Okay, that goes hand in hand with number 2 and 3, right? Ensuring all debts, expenses, and taxes are paid or adequately secured. And I added that phrase adequately secured for a reason. You may not be able to pay certain things because, you can't file the final individual tax return early. You can't. It's a calendar return. IRS won't allow you. So if someone passes away in February of 2025 and you're ready to make distributions in December, right? You can't file that return until, I believe the earliest you can file a personal return is after January 28th or January 29th of that following year. So you have to wait, right? So you need to be holding back those funds, talking to this, but you can get, you can be proactive. You can talk to the CPA and say, hey, this is everything that we have. What is the anticipated tax liability? And then you can tell, the CPA will tell you, well, based on this, we think you're going to owe $10,000 in personal income tax. Okay, you bring that to me. I say, okay, well, we're going to hold back twice the amount just in case. Plus, we're going to hold back a little bit more for the trust income tax return. Plus, we're going to hold back a little bit more for any final CPA attorney's fees. Plus, we know that there's a property tax reassessment coming in that we have not received yet. We're going to hold back for that, right? You're making sure you're holding back an appropriate amount. Okay. Now, if all of them have paid, that reserve can be less, right? If all the beneficiaries have signed all the documents, we've sent them, they're complying, and you've paid everything, then the reserve, you're still going to hold back a reserve, but maybe it's minimal. Maybe it's a couple $1,000s, right? And we're guiding you through that process. And then again, follow the trust instructions precisely. Can't tell you how many times people go, well, I don't want to make this distribution in this manner. I want to do it this way. Well, the trust says specifically to do it this way, and you are going to do it a way that's not appropriate. That is a breach of the trust. Yes, it may be more complicated. Yes, it may be a headache. Yes, it may be annoying to the trustee or the beneficiaries or whoever, but you have to follow the terms of the trust. But bringing it up to us, we can still strategize. We can come up with creative solutions, and maybe there's a ways to alleviate that, but we have to have that discussion, right? Don't do it and then have us say, hey, you weren't supposed to do that. Now we have to find a way to correct it or remedy it, and there may not be a way to do that, or if there is, it may be very expensive and time consuming. Okay. Communicating with beneficiaries. That should just kind of be a overarching theme throughout the entirety of the administration. Okay. And these are kind of just some very, as you can see, common sense, logical approaches to do that, right? Providing clear updates on progress and timelines. Even if it's just to say, hey, we're stalled out on this, the buyer's doing this, we had to extend escrow 60 days. Just let them know so that they understand. People will be planning, right? They shouldn't be planning on this because there is no actual timeline for when they're going to be getting it or how much because of expenses and creditors and other things that can arise. But they will. They absolutely will. And they're going to be expecting, not only will they plan for it based on the expectation, they're going to expect it, like I said, yesterday. So providing clear updates, even if it's minimal or even if it's just to say there's no progress, you're keeping them informed, right? And you're addressing questions and concerns promptly. And promptly could mean that you're not even answering the question. It could mean that you're acknowledging receipt of the question and saying, hey, they sent you an email and within 48 hours, you sent an email back saying, hey, look, received, I need to consult with the attorney to get the appropriate answer, or I need to consult with the CPA to get the appropriate answer, right? You're giving them just saying, hey, I'm acknowledging you're communicating, I'm communicating back, and I need to consult with others, right? Or, in instances that saying, the attorney has to respond to that question. The CPA has to respond, or the appropriate person has to respond, and you're redirecting them to the appropriate party, okay? By doing these things, you are building trust through consistent communication, okay? Now, this is generally speaking, you and I both know that certain people, certain personalities, it does not matter what you do, it does not matter how you communicate, it doesn't matter the mode, the method, how effective, how timely, they are not going to be satisfied, right? But as a general rule, you're going to do this anyway, right? You're going to do it for every single person that's a beneficiary of the trust, right? You're going to be, now, again, consult with us and we'll tell you what you are authorized to be providing and not providing based on a particular person's role in the trust. But again, that's kind of the general consensus. You're communicating, you're providing updates, you're building trust. And if, again, for some reason, someone's not okay with that, and look, sometimes you're dealing with a family member who you've had a strained relationship for 30 years, or a contentious relationship, or no relationship. This person disappeared and now they're coming back to claim their 30% of the trust and you don't know how to handle it. We're walking you through that. We're telling you how to communicate. And in certain instances, we're creating a scenario where you're directing communication through that person through our office, right? And we're doing direct contact if the circumstances arise where that should be necessary. Okay. Again, that's usually, full disclosure, that's going to increase attorney's fees whenever we're doing the direct communication, but sometimes it's necessary. Sometimes you're dealing with people where it's just absolutely necessary for the attorney to be the one who is the direct contact point for communication and messages and updates. Okay. Along with that, this is just a reminder, tracking all income, tracking all expenses, tracking all disbursements. All of this is necessary just to protect yourself. Okay. You need to be tracking all of this for tax purposes, for accounting purposes, for liability purposes, and just for your general record keeping purposes. Okay. We talked about retaining invoices, receipts, bank statements. And again, all of this is for all those reasons, but this last point is also something I want everyone to be aware of. But be prepared to provide regular accountings for beneficiaries. It does not necessarily mean a formal account is going to go to the beneficiaries. It doesn't mean a formal account is going to be filed to court, but you should be prepared to give one so that if anybody does request it, we can, you, the trustee in my office, will have a discussion on strategy. What can we give them to negate additional expense? What will satisfy their concerns? What information are they trying to seek so that they can make a determination on whatever they are going through or trying to decide? And we will work with you on that. But ultimately, if a formal accounting is demanded, right, and we're serving other beneficiaries, or we just, based on the longstanding familial relationship and the issues that have arose, we know that we're not going to get compliance from, person 1, 2, and 3 are going to comply. Persons 4, 5, and 6 are not going to. Maybe we just file this formal accounting directly with the court and seek court approval. Okay. The fact that you're prepared cuts down on time, cost, expense, and stress. Okay. Now, when I say stress, it's not going to be a leave completely, but as far as trying to gather this information and be prepared, not only helps expedite the process, which means an expedited resolution, it keeps costs down to the extent that you can. And it also shows the court and the beneficiaries, usually when you're keeping detailed and immaculate, pristine records, right? A lot that goes a long way, right? It's like, hey, I'm doing my job correctly, right? Here's the backup and support to demonstrate that. Even if the beneficiaries aren't happy with the decision I made or aren't happy with the way that our family members disinherited or reduced our interests, I did my job, right? My job as trustee was to do this, and I did it. Okay. And then meeting legal requirements, understanding understanding what must be included in formal accountings versus informal accountings. Again, keeping immaculate records, keeping the bank statements, keeping the valuation reports, keeping the support of the expenses, the appraisal invoices, the backup receipts, funeral costs, last living expenses, hospital bills, you name it, having all of that having all of it, gathering all of it, and organizing it. Yes, it takes time. Yes, it is tedious, but I can't tell you how much time, stress, and expense it will save in the future. Okay, it's one of those things where if you're proactive and you're doing it from the start, it makes it easier from an ongoing basis. And then also it will undoubtedly save time and expense in the future. Okay, it's one of those things where you're going to put in some sweat equity up front and it will pay off in the end, even if there's a lawsuit, right? Even if you're being sued for something as trustee, it will pay off immensely. Okay. And then avoid errors that can cause legal exposure. That is something, that's kind of a vague comment there and more obvious. But again, what errors would that even be? Again, that's just something, if you're doing everything that we just talked about, you're minimizing and reducing the chance of error or exposure. Okay. If you're doing all of that, it's reduced immensely. However, it doesn't mean you're completely absolved. It doesn't mean you're going to be able to completely do anything. Nothing that we do is 100% guaranteed, right? And that's probably a good segue to most of life. But again, we're trying to reduce exposure, reduce liability, and help increase the effectiveness of the estate plan, increase the efficiency, and increase the timeline. Okay. And lastly, consult professionals for all accountings. Formal accountings have statute of limitations, right? That begin to clock, the time begins on those for beneficiaries to contest and object. And if they're not done appropriately, they don't begin. So sometimes people will want to do them themselves to keep down on expenses. Please consult with the professional, consult with our office before you do that. Sometimes people have CPAs or accountants do that. Please consult with our office because there are, again, certain things, if it's not done in the appropriate court statutory format, if it does not disclose certain information, it will not begin those statute of limitations and you will not be protected. Okay. Even if you're giving all the appropriate information. All right. So it's something you need to consult with us at a minimum to make sure that you're doing that appropriately and that the right party is preparing this. Okay, and then lastly, in the webinar, protect and comply, avoiding pitfalls. So again, we've kind of harped on quite a bit of this, but I'll kind of speedily go through some of these things once again. Communicate early and often to prevent misunderstandings. Now, early and often can be difficult. You're grieving. You lost a loved one. You're dealing with funeral. You're dealing with people maybe flying in. You're dealing with a service and a ceremony. Sometimes it's as easy as like, hey, I'm named as trustee of this trust. I have not met with an attorney yet. I need to meet with them to go over the next steps. Just want to make you aware of it. I'm going to be doing this. Hopefully I aim to do this, within the next 60 days. Okay. Right. Just telling them, giving them a little heads up. Even if it's not, even if they're gaining no information from it, you're setting that expectation early. You're setting the boundaries early. And again, often, and I put that in quotes because it's going to be different for each particular administration. Okay. And that will help prevent misunderstandings. It will not completely negate them. No matter what you do, no matter what we do, there will almost always be a misunderstanding or two, but hopefully those are more easily fleshed out and dealt with because of the transparency and the communication that has occurred, right? And then documenting every action, again, keeping that just goes hand in hand, all the income that's coming, all the expenses, making sure your line item or if you're not itemizing, um, line iteming the actual income expenses. You're keeping the statements for the banks. You're timely organizing them, appropriately organizing them, getting the consultation from the CPA, the financial advisor, the trust attorney on what actions you are taking and what support you need to reflect that action that was taken, should anyone ask for in the future, and then involve neutral professionals when needed. Sometimes even if you're doing everything appropriately, that it's just not going the way that was anticipated. And we need to seek an independent, neutral professional. And that could be appointing a professional fiduciary, someone whose job it is to be a trustee, right? That's what they do for a living, or a corporate trustee, right? Where it's a bank trustee, or seeking help with a mediator, trying to solve a problem or a dispute, or an arbitrator, right? Or even a court. A court is a neutral um, professional, right? Technically, in one way or another, it's no different, right? So sometimes you have to involve these parties or entities or individuals for certain instances or problems, or if things are vague or ambiguous, or you're not sure if an action is appropriate, or not sure if you should take an action. Again, you're involving the appropriate people. And then building confidence and clarity, right? Staying organized with timelines and checklists. Sometimes the checklist is probably easier than the timeline. But there's general timelines, but as you can see, some things can happen quicker or be delayed depending on a whole host of parties. It could be you, the trustee, could be doing everything you're supposed to be doing. It could be the attorney's office, it could be the CPA, could be the IRS, could be the assessor, the recorder, the Department of Healthcare Services. It could be Medicare, Medicaid, Medi-Cal. It could be creditors. It could be business partners. I mean, the whole host of outside factors here that could delay the administration. But you're still trying to keep within those timelines, and timeframes, and you're updating beneficiaries when there's going to be delays. Okay. Always seek legal advice when unsure, right? That should be your default. If you're unsure, seek guidance first. Don't make the action and then seek guidance afterwards. Okay. That's almost, again, a lot of things can be remedied and corrected, but it almost always costs infinitely more. And now you're dealing with the potential of not being able to correct it. Okay. And then lastly, I've kind of harped on this throughout the entire presentation. Transparency and detailed record keeping is key. It is absolutely paramount, and it could be something that saves you from liability. And it could be a complete defense to a lawsuit in the future. Or it could be a defense to it, a challenge from the IRS on a tax return, right? Or a challenge to a financial statement or an audit, whatever the case may be. And some best practices, right? Just be proactive. Just be proactive. Can't always be proactive, but when you can, be proactive. There was something on the last slide, I don't remember, on a couple slides ago, that actually just thought came to my mind as far as timelines, knowing when to communicate, how to communicate. Sometimes that it's a period in your life where maybe you shouldn't be serving as trustee. Okay, maybe the responsibility is too great, whether it's grief, maybe it's just your own life. You have your own life. You have your own family. Maybe you have kids, maybe you have grandkids. You have work. You have stress. You have all types of things. And a lot of times when you have a trust, there are numerous trustees. Sometimes the best decision is looking at that and going, am I the appropriate person to be doing this at this time? Okay. And maybe you're coming up with an arrangement to say, hey, I'm going to decline. I'm not going to serve as trustee. I'm going to decline and have the successors serve for the next 3, 4, 5 months until I have my faculties together, my capabilities, my head on straight, and my other affairs in order to be able to do this appropriately. Or maybe, this is something that's above my capabilities. And yes, my loved one wanted me to be the first in line to do this, but I'm just not capable of this. And I've done a self-reflection on this, and I don't think I can do what's necessary to do this appropriately. And you're stepping down and getting the guidance to have the appropriate people. I had a client once where it was eight siblings. All 7 of the older ones declined in favor of the last named youngest sibling. And you know what happened? It was probably one of the best administrations I've ever handled. That individual was hands down the right person to do that role. And I can't tell you how efficient. There were so many tax issues and implications in that one, and so many asset complications and complexities, and it was done flawlessly. And everyone knew that this person was the right person, and they all got out of their own ego, got out of their own way to say, yes, I know I'm the older sibling. Yes, I was named. I'm going to resign in favor. So it's something to think about, something to be cognizant of as you navigate this. Okay. Final takeaways: proper inventory and appraisal form the foundation, right? That date of death inventory and getting the date of death values and the appropriate values form the foundation for managing the estate, right? Gathering the assets, finding where they are, valuing them, and appropriately documenting them is a extremely solid foundation. Staying proactive with taxes, financial management, right? And that's really you're consulting with the CPA and the financial advisor. You're forecasting what the anticipated tax liability may be, and you're holding back money for that. You're talking with the attorney and CPA to see if there's any tax saving strategies, and you're communicating, right? You're documenting and you're staying compliant at every step. Now, sometimes saying that is easier than doing it, right? Now, you're going to do this to the best of your ability. No one is perfect. Sometimes you may do something that's may not be illegal or unlawful, but it may not be the best case scenario, or it may have forgot to do something. That's okay, right? You're just doing your best. No one is asking you to be perfect. The law does not require you to be perfect. The trust is not required to be perfect. If you're religious, high power is not requiring you to be perfect. It's just you're doing the best you can with what you have, and you're seeking the guidance to do that. Okay. Conclusion: this is just kind of some overview of kind of things we can help with if you're not already a client, or if you anticipate someone's going to pass away, or if someone's recently passed away, right? Just meet deadlines, protect assets, reduce liability. Those are all very vague. We're really discussing each one of those in much more intricate detail based on your circumstances. Get trusted tools and guidance for every trustee duty. Again, that's more you're talking with us. We're going through those duties and making sure you're complying appropriately for the ones that actually are implicated in your matter and your family members' matter. Stay compliant, preventing disputes, and document every step. Now, staying compliant and document every step, that's much easier than preventing disputes, right? Doing those things will help prevent disputes, but you can't 100% prevent disputes. We have a lot of lawsuits that are filed, even when the trustee is doing everything that they should. Okay, but it does minimize, right? It does reduce the statistic probability that one will be filed. Okay, and this is just some general information about our firm. We've been open for almost 5 decades now. We have more than 10 full-time attorneys. I believe we just brought on another attorney in our tax and high net worth planning department. We've combined over 350 years of experience. A lot of individuals have advanced degrees. We have 2 or 3 certified specialists. We have a lot of highly qualified support staff, and diverse skills. We have numerous locations, and I've probably met with met with a lot of our estate planning attorneys via Zoom, phone, in person. We try to cater and assist and serve our clients to the best that we can. And then lastly, here's our contact page. We have our phone number, we have our website, our email, and our digital evaluation. I believe our digital evaluation is back up and running. For my last one, it wasn't working. It should be working. Please leave an evaluation, even if you don't like me, even if you thought this wasn't helpful. Let us know. Of course, I like the positive feedback, but I also take the negative feedback the negative constructive feedback is very important. And I hold that very dear to me because it helps me and it helps my team put together better presentations in the future, help provide more information, more insight. The whole idea here is to get more information out to the public, out to the clients so that they're better prepared. So that when this day comes, they are focusing more on grief than on dealing with attorneys and CPAs and professionals and having to deal with the administration, right? Because it's very complex and it's very stressful, especially at a time when you may be at your lowest. Okay. So let us know how we did. Let us know how we can improve. Let us know if there's topics too that you want us to talk about. I do scan that for that. Um, I've done an hour 15 here, so I won't be able to answer questions during this. However, please put them in the chat. Please put them in the Q&A. My team is taking snapshots of all of them, and they will email those to me afterwards. If there's something if there's a general question I can answer, I absolutely will. If it's not, I will let the team know and they'll get back to you and say, hey, this is too particularized. This is too specific of a question. You need to meet with an attorney so they can flesh out all the other information they need to give you the appropriate advice. Okay. So once again, thank you all for joining. It was a pleasure to be here with you today. Like I said, it brings me a lot of joy to be able to give information to try to prepare everyone for what is coming. And again, I'm giving you a lot of overview and I'm not trying to stress you out. This is an overview, a huge overview picture. If you're actually doing an administration, we're going step by step, day by day, right? That's all you can ask of me. That's all I can ask of you. But again, I enjoy being here and trying to give information to our clients and trying to prepare them as much as I can. Okay, so I'm going to leave this page up for a little bit so that you can leave the evaluation, contact us via email, visit any of our website or phone numbers to schedule any meetings or consultations that you may need, or any follow-ups, or if anything has arose in your life that you need assistance with, let us know. Otherwise, have a great rest of your day. Have a wonderful week. Have a wonderful November. And I hope everyone takes care. Okay.